Appreciate everyone taking the time out to join us here today. We really love putting on these events, and I think there is a very different process around. Appreciate everyone taking about some of the funds and the partners that we work with to help run 5 portfolios. Hearing us talk, and really appreciate the guys on 5B taking time out of the schedule to come in and actually do the presentation today. But we're always learning something new and exciting about the funds, the opportunities, and also the space. And I think that part of what we want to be able to leave here today with is a little bit more of that in terms of a bit better understanding about the process, who 5V are as a manager, and the opportunity that's in the private equity, especially the mid-market private equity space. And to put that in a bit of context, how we use that within portfolios, because we did find that sometimes there are questions around that and why do we like it. A lot of people here obviously know us and one of us from the team, but GP, growth and preservation, that's our key ideology with how we look at managing money. Obviously, we're looking to help people grow wealth. That's what we're here to do. But ultimately, we're going to make sure we do so in a way which we're preserving and protecting wealth. We want to ensure that we've got peace of mind, we can sleep at night, understanding the method, the process, and not just the upside, but also the downside of how we of what we're investing in. And this is a really, really good example of a space that we find very, very attractive. Before I introduce Chris, who'll speak for about 25 minutes, we are recording, so if we can just keep questions a little bit towards the end, that'd be appreciated. But we'll have plenty of time for Q&A and to talk a little bit more around the fund. But in terms of a bit around our process, the team, and I think a lot of the strengths of how we operate with being able to kind of specialise and I think isolate duties within the team structure ourselves gives us the ability to meet with more managers in the marketplace, and also what we believe finding best of breed managers amongst that group to be able to bring to clients and fit them within portfolios. And that's a process that we provide, our clients on a regular basis. And 5V is the manager that we have selected in the mid-market area of the private equity space. And in terms of that team benefit structure, hopefully there's a lot that people take away from that in terms of the idea generation we're able to provide on a regular basis. But the relationship we've developed with 5V over the past year and a bit now has been working extremely well, and something we're looking to continue kind of going forward. Just in terms of how this can fit within a portfolio process and a bit more around the private equity space and why we like it. Now, this is just an example of a portfolio solution that may fit like a balance or a growth profile, but the private equity area has a pretty wide, I think, umbrella term where it can mean anything from venture capital to early stage investing to early stage, mid stage growth and the later stage growth. And we see this in the mid-market area as a place where it's got limited downside or quite acceptable downside, but considerable upside. And there's a number of things that we really love about the area, or I should say that if you look at some of the stories in areas such as VC, there's natural risk and reward in that area that makes us a little bit less excited about that. Typically, I think VC might be about 60 to 65% of companies that they invest in that area probably don't produce a positive outcome. They're reliant on a much bigger, I suppose, concentration of successful businesses to drive their returns, and that can create a really big span of results that can sometimes be quite unacceptable. As you look at the more mature businesses that in this space is a good reflection of that, you're significantly able to de-risk that kind of composition, and that's what we want to look kind of at favouring a little bit more toward. When we look at the quality of the businesses, these businesses typically are a lot more kind of recession-proof and a lot more stable through the cycle. That's another great attribute that we love. They've generally they're using lower levels of debt. And some of the areas that can be quite, I think, hairy in private equity and like leveraged buyout areas that when markets do turn against them, that can create another layer of problems that can sometimes be limiting towards the return outcome. I think the risk control and the risk reward of this space and 5V makes us extremely excited about that area. Even though I think if you look at the average returns in the mid-market space, it's a resilient investment space. It on average does about 3 to 5% above the ASX in terms of average returns. And on top of that, it actually, when the ASX is performing 8 to 9% or below, the actual outperformance is about 20 to 30% above the average. So it's probably about from 4 to 7% on average. rather than returns are higher in the market. So it's got the ability to actually drive higher returns during soggier conditions. So the work that we've done in we think focusing on that gives us a lot of excitement about how we include that within the portfolio. Other areas we really like is that they back their own word. When they're heavily invested in their own fund, which I'm sure they'll go through in a moment. But also, if you look at the caliber of the founders, the alignment of interests within the portfolio itself, they're things that we really gravitate towards as a manager, and why we see them as a key partner for us, not just now, but going forward as well. I'll let Chris do the intro for 5V and their process, but I'll just do a quick intro for Chris himself. But Managing Director at 5V, where he heads investment across technology, IT services, and broader business services. He's spent more than 20 years working with companies globally as a private equity investor, director, and advisor, including nearly 15 years in Australian private equity. Prior to joining 5V in 22, he was Managing Director of Adamantum Capital, one of the earliest members of the team, and before that, as a Director at Anchorage Capital Partners. Early in his career, he was Principal at Bain & Capital, working across the London, Sydney, Boston, Johannesburg offices, and began his career at Ernst & Young Corporate Finance. So a little bit about Chris's background, who we've been hearing from today. And without further ado, I'll hand over to Chris and take it from there.
A round of applause. I'm not used to that, that's for sure. But sorry if I check this, I'm not checking my email. It's just a couple of notes. But well, thank you, Brennan. And yeah, thanks to everybody for coming to join. I appreciate you taking the time out to learn a bit about 5V and Horizons, which some of you will know, but Horizons is our product that makes it much easier for individual investors to access, what was traditionally a hard asset class to access, but a very high returning asset class, which is mid-market private equity. But yeah, really appreciate being back at Shores. We have had a great relationship with Shores over the past few years. We've done a couple of these types of events and morning meeting attendance, but really appreciate the partnership and interest from Shores in what we're doing. So, and thank you again for taking the time to listen. So, I'm not, just while you eat, I'll take you through a bit of a presentation. I'm not going to drown you in slides. It'll probably be like 20 minutes or so, so we'll leave plenty of time for questions at the end. But just give you a bit of an overview of 5V and who we are and the types of things we invest in. I'll talk about Horizons and why it's unique and why we launched it. And then for those that know a little bit about Horizons or already invested or following it, I can give you a bit of an update. There's been quite a bit that's happened. A few great developments in Horizons over the last probably 6 or so months since we were here last. So, and yeah, lots of time for questions at the end. So, the Horizons Fund. So, who is 5V? So 5V are growth partners. So we aspire to be the growth capital partners of choice to the best businesses and we only want to invest in the best businesses in the mid-market in Australia and New Zealand. So we generate our returns through growth. We're a private equity firm, but we do not use lots of leverage. We are generating our returns through equity growth. We're not turnaround people. We're finding great growing companies and we're partnering with them to help them grow. So what does that look like? Daily, we spend a ton of time out researching very interesting thematics in the private markets. We then research to find the best businesses that we can in those that are benefiting from those growth rates. We construct a partnership with them whereby we invest in their business and then we help them on their journey to grow. And we're only trying to find situations where we really feel like we can help them with their growth, so that, as we take capital and invest it, we're finding situations where we believe we're adding value to that company's journey, which is the justification for us being there in the first place. And then ultimately, we're exiting those investments and generating what has proven to be a very, very high and market-leading return on capital. So that's what we're doing every day. A bit more about us. We manage about $3.5 billion in funds under management. We've got 70 people in the team, and that's really, really significant because we're the biggest team by a long way in our part of the market, in the mid-market. And a lot of that team is not only like a very high caliber investment team, and we've never lost anybody from our investment team. We had 2 people that didn't pass probation, but no one's ever left. So we're developing a very high caliber investment team, but we've also around that got a dedicated group of people that all they do is go and originate and try and find great businesses in the mid-market. And it's not like public company investing where there's an observable universe of companies to go and invest in, and everyone can access those. A critical differentiator in private equity is your ability to repeatedly go and identify and find those very interesting businesses out there to partner with that aren't necessarily observable to everybody. And then at the other end, once we've invested in companies, we've got a very big team, by far and away the biggest in the market, of people that all they do is just work with portfolio companies to help them grow, help them build value in the company. So these are people helping them with technology, AI, strategy, and also their M&A journey as well. So that big team is very significant and very strong alignment. So Brendan talked about the partners and employees of 5V have about 250 million invested and committed to 5V. So we are big believers in what we do. Everything I don't live in is invested in private equity, in 5V funds. And hopefully that's very comforting to people that choose to invest alongside us, because we are very, very heavily aligned with them through our own money. And very importantly, as I said before, we're growth focused. So these are not leverage buyouts where we're buying a very mature business using lots of debt and needing that debt to eke out a return. This is not turnarounds and breakups and asset stripping. This is finding great businesses that are already growing nicely that we can help grow over the next 3 to 5 years of their journey, but bring real value to that. So we're generating all our returns from growth, not from deleveraging or breakups or turnaround or things like that. Very importantly, we focus deliberately on the mid-market, as Brendan said, and that's, so these are businesses, private companies that are typically valued at less than $500 million. And there's a very, very important and deliberate reason that we do that. So we very deliberately do not want to be doing multi-billion-dollar private equity deals. There are very few of those in Australia. They are very visible deals. Those companies that are of that size are easily observable and visible. Everybody's chasing after them. All of the international firms that operate here, the KKRs, the TPGs, the Blackstones, are chasing after those very few deals each year. So they're very competitive. The multiples that are paid are very high, and candidly, the returns potential is not very exciting for us. So we deliberately focus down in the mid-market where there are orders of magnitude more companies. So, in the part of the market that we look at, and again, that sort of below 500,000, depending on how below 500 million in value, there's, north of 20,000 companies that are of an investable size for us. You compare that to the public markets in Australia where there's about 2,500. So very, very big opportunity set, very, very big investable universe. And for us, I talked about that origination part of our team that we have. We can get a really, really big return on employing that team to go out and find these really interesting and innovative businesses that aren't readily observable to others. And that's a key differentiator in private equity. But what's very significant as well, and the Shores guys in this room will understand this because a lot of these businesses are their clients, an enormous number of these businesses are in transition. So depending on the stat, it's expected that over the next 5 to 10 years, more than half of these businesses will transition. And growth capital partners like us have an important role to play in that transition. Quite often, family-owned businesses or founder-led businesses want to do a multi-stage transition. They recognise that right now, if they tried to sell their company, they would not maximise value. So what they want to do is take a bit of money off the table, bring on a capital partner that has done this many times before, help them go take advantage of a few more of the growth opportunities they see on the horizon, help them corporatise and institutionalise, in many cases help the founder transition as well to a sort of a professional management team, and that way maximise the value of the business that they've built up over 20, 30, 40 years. So private capital of our type has a huge role to play in this transition and a very, very significant opportunity. Again, as the Shores guys know very well. And look, just to round out sort of the overview of 5V, very proud of our returns. We've generated north of 30% IRR since our inception. That's a net figure. That's a net of fees. That's returns to investors. And by any metric globally, that's top quartile returns. But we've also done it by consistently returning capital quickly to our investors. And we make all our returns, actual realised returns, when we exit our positions and return money to people. And so we've been top decile in terms of those actual pace of returning of capital to people. And so the average hold period, because of the repeatable sort of value creation playbook that we've developed, it's only been about 3 years. And the oldest thing in our portfolio that we own is only about 4.5 years old. So obviously increasing the value of a company is how we generate returns, but way better if we can do that quickly. And so a lot of the team and resources that we have and the playbooks that we've developed are about doing that repeatably and quickly to generate strong IRRs for our investments, for our investors. And we've now done this, been doing this for a long time. We've done this across 36 platform investments and many, many more add-on investments. And many of you will know that some of the small add-on acquisitions that can be made during the ownership period can be big drivers that can be very strategic and very synergistic and can add a lot of value to the equity returns. And here's just a couple of the examples of some of the businesses that we've exited, and happy to talk about any of them. Great businesses that we're proud to have been in partnership with, but we've sold the vast majority to strategic or private equity. And one of the nice things about being in the mid-market, if we're finding a great business that's sort of valued at 150 million, we're selling a company that's worth 300 to 400 million. There's a lot of buyers for a business like that, a lot of exit optionality. So it's a very nice size for a strategic acquirer, but it's not so big. Like if you're trying to sell a $2 billion company in Australia, depending on the industry, there may only be 1 or 2 strategic buyers globally who could even buy that asset. And if they're not ready right now because their share price has been impaired or it's not the right time strategically, what do you do? And so the businesses we're selling are of really relevant size to strategics, not only in Australia, but globally, but also of a very attractive size to larger private equity that's operating more in that large cap space we talked about. So we've sold a lot of businesses to KKR, to Advent recently at the back end of last year, Tenzing, which is a leading European mid-market fund. So, and that exit optionality in private equity is very, very important. So it's been one of the challenges in, as some of you will be aware, in large cap private equity. You hear about lengthening portfolio ownership periods, etc., long hold periods, assets that are just sort of stuck. Not really a feature in mid-market private equity. And the reason is just size of the company. Again, if you're trying to sell a $2 billion company, it can be very difficult. Trying to sell a $400 million company, $500 million company, lots and lots of buyers. So that's kind of who 5V is. Appreciate that's pretty quick, but happy to, we'll come back to questions in a second. But so what is the Horizons Fund and why did we launch it? So as Brendan touched on, look, private equity globally and also in Australia has been a really, really high returning asset class. It's consistently over the last 20, 10, 5 years outperformed public markets. It's been true globally and it's been even more true in Australia. And Australian private equity has outperformed global private equity in terms of returns over that same period. So it's been a really high returning asset class. And what that's meant is that globally over the last 20, 30 years, the big investment managers who can, pension funds, endowment funds, super funds, etc., those that are big enough to pick and choose wherever they want to invest, they've been allocating 15 to 20% of their portfolio to private equity. And I think in your model portfolio, you were sort of double digits, around 12 there. Most Australians today probably have less than 5% exposure to private equity and often just indirectly through a super fund. And the reason is because it's just been a very hard asset class to access. Most private equity funds and still the bulk of our fundraising is done through traditional closed-end funds. These are 10-year funds. Very large minimums, multi-million-dollar minimums, and no liquidity until we exit something from the portfolio. So the way that works, you make a commitment to the closed-end fund. We call capital when we need it. You've got to have the liquidity available at 10 days' notice, and then it'll come back whenever the private equity firm is able to get an exit. So very lumpy cash flow liquidity profile. It's very difficult for individual investors to manage, even if they can meet the multi-million-dollar minimums. So Horizons is designed to solve that. It's an evergreen fund. It's available on all of the major platforms. I think it's 8 now platforms, and including all of the major ones. And it offers liquidity on a quarterly basis. But at the same time, it invests in exactly the same underlying assets that our closed-end funds are investing in. So just as an example, we invested in a great business called FTP recently, globally relevant mining software business based out of Perth. One of our closed-end funds has taken about 80% of the equity check that was needed for that, and Horizons has taken the remainder. And that's how Horizons works. It's only investing alongside our closed-end funds. It's never leading an investment. It's never investing when our closed-end funds have not. So it's got 100% alignment with our closed-end funds and with all the principles in 5V. But it's over time is building up a diversified portfolio of these direct co-investment positions that hopefully, tries as best as we can manage to replicate the underlying portfolio performance of the closed-end funds of 5V. So the other things and what we've tried to do in this sort of direct exposure is to, as best we can with this product, kind of replicate the experience of investing in the closed-end funds. So these co-investment positions in particular assets, you will always know exactly which assets you're invested in. You'll have direct exposure to those assets, just as you do in this sort of closed-end fund. And there's no multiple layers of funds. So sometimes when you invest in global private equity products, it's a gateway product. So you're paying fees at the top, you're paying fees on the way through. This is just one layer of fees that's exactly the same as the fees in our closed-end funds. So almost we're trying as closely as we can to replicate the experience of investing in our closed-end funds just with that liquidity option for people that need it. Now, we do encourage people that the assets underneath are illiquid, and so it's not a product that you want to be thinking about kind of trading in and out of around the net asset value, but there is liquidity if you need it on a quarterly basis. But also exactly the same institutional quality approach to finding the best quality assets, diligencing the best quality assets, managing them professionally with the board and all the resources that we have. Because again, it's exactly the same businesses that it's not like we're putting a certain type of business in Horizons and a certain type of business in our closed-end funds and making subjective allocations across those. Everything that goes in the closed-end funds, Horizons just takes a piece of that. And so it's benefiting from exactly the same type of assets, same approach to management of them. And again, I talked about the amount of money that we've got invested alongside you guys. It's hopefully gives a lot of comfort around that, to confidence in what we do. And we're targeting 15 to 20% net returns for Horizons. That is lower than we have generated historically. Again, the usual caveat about past performance versus future performance, but the main reason of a slight difference between the returns in the closed-end fund and Horizons is we do have to keep a portion of cash available in Horizons just to manage upcoming future investments, but also any liquidity needs as they arise. Mind you, up till now, there's been less than, I think it's been like 0.1%, right, that's been redeemed. So that's an overview of Horizons. Where does it stand today? It's delivered since its inception about just under 3 years ago, about 14% net returns. It's got 21 assets, so it's going to be broadly diversified, and it's now got about 450 million of asset value. I think a really important thing to understand about Horizons, though, is by design, it's been going through a build-up period because we launched it in July 2023, and it's been in an asset accumulation phase since then, investing in assets that 5V has invested in since that time. But as we start to get to maturity now, we expect over the next 12 to 24 months, while new assets will come in, we will start to also exit businesses that we have held in Horizons for 3 to 4 years. And when we do that, you'll start to see realised returns come through, and every asset we've ever sold has been sold for more than the carrying value at the time. So Horizons is yet to, even with those returns, is yet to get into that period where there's consistent realisations, which is fundamentally part of our model. Very important to point out as well that it's active investment, and one of the things we love about private equity is we're on the board, we're working with the CEOs, CFOs, COOs every week, talking to them sometimes daily. We've got like between 4 and 6 people in our team working with every company. We're extremely actively involved, both in strategy at the board level and down through the organisation on particular projects. So this isn't a case like public equities where you make a thesis and you put your money in and you hope the share price goes up. If things aren't going exactly according to plan, and in business they never go exactly according to plan, you have the chance to course correct, roll up the sleeves, make changes, put capital in, hire more people somewhere, you have the chance. So it's very, very actively managed, and we have a big chance to impact the outcome of that business, not just put our money in and then hope that it delivers some value one day. This is just a bit of a flavour of the businesses in the portfolio and the portfolio mix at the moment. So yeah, a good mix of healthcare, government, infrastructure services, pretty broadly diversified, candidly. There's 21 assets in there at the moment. And they're all great. I wish I had time to talk about all of them, to be honest, because they're all amazing stories, generally great Australian businesses that are founder established with a great origin story. They've grown to the size at which we meet them, and now a really exciting opportunity for those businesses to partner with us and then go after another great, exciting sort of 3 to 5 years of growth. So these are all businesses that we're meeting at, early stages of, they're very well established and they're all profitable and growing, but they're still early enough that they're really in the high growth phase of their life. We're not sort of buying businesses that are so mature and established that their growth's really starting to tail off. We're catching them at a very exciting time in their life, and look, growing very, very strongly. So you can see some of the growth rates there on the top across some of these businesses. And again, I wish I had time to talk about them all because they're all just great individual business stories, but growing very, very strongly. And our job is to partner with them and help them generally with sort of three things. We're investing behind a very clear organic growth plan. That could be to launch into new geographies, launch new products, launch new services, capture more of the transaction value and the margin. We're also helping them with corporatizing and institutionalizing, because quite often these businesses, they haven't had a CFO before, their financial reporting needs an upgrade, they haven't had a board, they've often been led by founder vision rather than a very clear strategy and clear growth plan with clear accountabilities and resourcing that can be communicated to the business. So by the time we exit them, they are well institutionalized and corporatized, which builds a lot of value. And then we're also driving a lot of value through add-on M&A, as I talked about before. So an example there, Dyflex, absolute leader in SAP consulting. The market trend it's benefiting from is that SAP has now mandated that all on-premise instances of the ERP must migrate to the cloud before they turn off support for that in about a 5 to 7 year period. And about 70% of the global instances of SAP are still on-premise. So massive wall of work coming for implementation partners. We identified that trend. We found the best business they're 3x the size of their next independent, the next other independent in the market, partnered with them to drive a growth plan. So that's the growth plan has been, they were WA centric, help them move over to the East Coast and build up over there, help them hire some key people to move into other parts of the SAP suite so we can drive cross-sell, help them move into New Zealand. Then in terms of corporatizing, they'd never had a board. It was a founder-led business. They'd never had a CFO, a chief people officer. The founder, by his own acknowledgement, was a good founder, not necessarily a perfect CEO, which is something we see commonly. We've hired a professional CEO into that business. So really kind of corporatize the business and make it ready to grow over the next few years, whereas probably the way it was set up a year and a half ago, it couldn't take advantage of the growth opportunities in front of it till it had some more resources in the back office. And then M&A, we've helped them execute on one and another one coming up of really strategic M&A opportunities that help them with that geographic expansion or that service line expansion, just as one example. So so that's sort of horizons and the types of businesses we're investing in and how the product works. I'm sure there'll be more questions on that, but perhaps just to give a quick update for those that are more have been following it for a while. So in the last 6 months, we've invested in a number of new exciting companies. So I'll talk about one of those, which is FTP. So FTP is a globally relevant mining software business. So Australia is obviously a global mining centre of excellence. A lot of the biggest mining companies in the world are here, BHP, Rio, Fortescue, etc. They're also the most tech forward of the mining companies globally. And so Australia's become a centre of excellence globally for mining software. And these guys have a really amazing products that selling to BHP, Rio, Fortescue, Anglo, Vale, the big global names. And it's a piece of software that's absolutely critical if you want to run an autonomous mine site. So big trend in mining towards using autonomous trucks and machines on mine sites for safety, because you don't need people in there. Also for cost, because they're far more cost efficient. They don't over-rev the engine, and you don't need to pay labour hours. And basically 75% of all mine sites globally that are running an autonomous program use this software. So as autonomy grows, this business is going to grow rapidly. They've also got a bunch of other product extensions that they're launching as well. So multiple growth levers for the business, and a globally relevant company. And again, an amazing founder story, an ex-military guy who was a network engineer in Afghanistan, wanted to create a pathway for people coming out of the forces into private life. So all his formative employees were ex-services coming back from Iraq and Afghanistan, and network engineers that then applied their skills to the mining space and built an amazing business. But, the stage they're at, we need to hire a CEO. They've never had a proper CFO. They've never had a functioning board. They've had a board which is very dysfunctional. You can't get the right data out of the business every day. So despite an amazing product and amazing growth, a lot of opportunities to corporatise, professionalise the business. We've also had an exit. So Atomic Group, any of the Shores guys will be familiar with Atomic. It's the leading disruptor in the registry space, taking share from Computershare and Link. We exited that investment. Horizons, the portion that Horizons owned, realised a 60% IRR. Amazing partnership involving organic growth, launching new products, but also M&A, which tripled the revenue and EBITDA, and ultimately sold that to a global private equity firm who, for them now, next opportunity is to take an Australian-centric business and take it up through Asia. So great pathway ahead for them, leaving that growth story on the table for them. And the returns coming along nicely. Look, as I said, we've generated sort of 18% over the last year, not 14% since inception. These are all net of fees, so net to investors, but it's building as we thought it would. We are still in the scale-up phase I talked about. We will now start to get into this phase of where there's new assets coming in, but we're also exiting and realising the assets, which will return a lot of, we think will be a good driver of returns for the fund. So, look, I'll probably leave it there. Thank you again for your attention and interest, but loads of time for questions now, Brendan. So
I've got one. In terms of environment, I know because one of the great things we enjoy about this fund is the evergreen status, but historically buying conditions and exit conditions are really important when you've got a lock-up fund. Mm-hmm. Buying conditions at the moment, and investing conditions at the moment, how would you describe them when you're allocating new money?
Yeah, look, obviously there's always something going on. This year it's Iran and recent releases in AI. Last year we started the year and then Trump came out and launched a whole bunch of new tariffs, right? So there's always something that's going on. I think for us, what we're investing in, we're not macro investors, right? We're not trying to pick an interest rate cycle or a currency cycle or something, or a construction cycle. We're finding these great businesses in an observable market niche that is growing regardless of what's happening in the broader market, right? Like Cyclotech, and we're getting behind those businesses, and we're investing behind the specific growth opportunities they can see in front of them. And those growth opportunities, I think, opportunities that company only can take advantage of that aren't dependent on interest rates or inflation or Iran. Now, we do see some second, third order impacts across the portfolio, but history would show with the growth rates, that's more than trumped by the, bad use of the word Trump there, but more than comped by the opportunity that the growth opportunities that the companies see in front of them. So, I mean, an example, if we go back to, Cyclotech, it's probably the best slide here. As one example, that business is by far and away the biggest provider of radioisotopes for cancer scans. Cancer scans are growing rapidly in Australia and globally at double-digit growth rate because there's new scans that have come out that are more effective There's earlier diagnosis of cancer. If anybody's got cancer, then you've got more frequent screening. So that trend of increasing cancer scans is not impacted by what's happening in Iran or inflation or tariffs, and we're selling 90% of the radioisotopes to private radiologists in Australia. And the opportunity there is to decide whether we build a new cyclotron, which is what's needed to make the radioisotopes in a new region. Do we move into New Zealand? Do we buy a small competitor over there? Do we move up into Singapore? Again, all these things are micro opportunities available to that business in that really interesting niche. So it's really, we don't pretend to be good at macro. We've always got to deal with macro when it comes along, but we're not getting behind trying to pick big macro trends in the portfolio.
There's an allocation there for infrastructure.
Yeah, it would be services too. So there's businesses in infrastructure services, for example, like Orican. So Orican is the leading provider of technology to local government for parking. So if anybody's had paid parking fees or parking fines recently, thank you. We get a small clip of that every time. But they provide about 70% of the technology to councils all over Australia for that marketing technology. So that is both the machines on the street, but also importantly, the software that the council uses to know where all its assets are, receive the fines, clip the ticket on the payment, but then also receive the parking fees and then also administer the fines. And that's second biggest source of revenue for most councils in the country after rates. So that is sort of, that would be in that government and infrastructure services. Blast One provides industrial services to large projects, for example, as well.
And so how many businesses would you meet with a year, filter through, and then kind of make actual executable trades on makers there?
So we invest in about 2% of the companies we meet. So we screen enormous amounts of companies, thousands a year. We screen out a lot of those without any meeting, just because we don't like the space they're in, or it's too small, or we can see it's not got the right revenue profile and margin profile. Then a subgroup of that we choose to meet. That's hundreds a year, and then we invest in between 4 and 8 businesses a year, which is about 2% of the ones we meet. So.
Do you compete with other businesses in those meetings that are trying to do the same thing?
So in the mid-market in Australia, the only real competition is other firms that are other local firms. You're not really competing against the globals.
Yep.
So sometimes we will respond to an opportunity that comes through an advisor. In that situation, we're likely to introduce some other firms like us. And then other times our origination team is going out and driving a bilateral discussion with a business to create an opportunity where they're only really talking to us. So we do both. We have to be very careful around where we spend our time. Luckily in the mid-market, you've got a lot of things to go and look at. So if we we make a pretty quick call on whether we like the business and whether we like the situation. So if the advisors come along and said, this founder is really looking for a partner, and I'm only introducing this person to 3 or 4 firms, we'll lean in there if we like the business, because we're pretty sure the biggest team in the market, the best track record, the most value addition parts of our team, we're pretty sure we'll win the asset, and that's a good use of time if we like it. If the advisor turns up and goes, they're selling 100% of the business, it's all about the highest price, and you can't take too long to do your due diligence and things like that, we just will say no and spend time elsewhere. But the nice thing about the market is that a couple of things. One, there's really only a handful of what I would say are tier 1 private equity firms that are considered for and introduced to the best businesses out there. But there's also, with tens of thousands of companies, there's enough for us all to be going and finding investments and not crossing over each other all the time. So we can do well with our other PE cousins doing well. And again, it's been a good place to invest. So there's others other than us that have done well. We think we're the only one though that are sort of trying to be a platform with a real repeatable model of how you find businesses consistently, deploy capital consistently, build value consistently, and exit consistently, as opposed to where a lot of firms are, which is just a collection of people running around trying to find deals, hoping to jag a few investments. Sometimes you do a lot, sometimes you do You don't. Sometimes you get a good one, sometimes you get a bad one. We're trying to drive a repeatable model that drives consistency in all of what we do.
So, Chris, thank you for the presentation. It's
No
very
problem.
interesting. I'm interested in your exit strategy, the timing of your exit strategy and how that process works.
Yeah.
And who fills the void that you leave in these businesses.
Yeah, so so the exit strategy is very asset dependent because it's determined by when we think we can get an appropriate return on that asset based on what we can see in front of it, But in general, and it is in general, when we invest in a company, the best theses we can underwrite are where if we achieve our growth plan, we're building something for a group of logical strategic acquirers. So we're like, it's okay, great. We can grow internationally. We can launch this new product. At the end of the day, the business is going to look different, and that's only interesting if that's going to be interesting for somebody. So the best theses we can underwrite are ones where we think there's a really logical group of strategic acquirers that have demonstrated that they are acquisitive and pay good multiples historically, and we can build something for them. So the plans we're getting behind generally have a bent towards a strategic acquirer. But what we've seen the the sort of increase in over the last decade, and I've been doing this for 15 years, is larger private equity firms looking to buy things, exciting high growth businesses from us. And just like Automic, that was a great deal for us, but also a great opportunity for Advent, who's a global firm, because they can now take Automic up into Asia where they've got teams and other portfolio companies that can help them grow. So, but a big part of our job is as soon as we sort of the first 6 to 12 months is just rolling up the sleeves, working really, really hard in embedding the pillars of growth, hiring the right people, making sure the growth initiatives are kicked off and running. But as soon as we are pretty sure that the business is on a good path, we're heading towards a good return, we start really early engagement with buyers. And in many cases, we sell to a company that we might have met 2 years earlier or something like that, because that's the best way to get the premium outcome is, to turn up to a strategic acquirer and say, hey, look, just telling you, we've got this investment in this business. They do what you do in Australia. They're very well positioned. They're growing very strongly. And then turn up in 6 to 12 months again and go, last time I saw you, we told you we'd do this. We've now done that. And in all of that time, the strategic has time to do their own research and start to think about, as they evolve their strategic plans for the region, think about how this business fits in. But quite often in that process is the acquirers don't wait for you to then run a process when you're ready. They come to you and say, we don't want to wait for you to run a process. We know you're still thinking about doing something next year or the year after, but we want to do a deal now, and they know they have to pay us next year's price now. And so that has probably been what's happened in more situations than not. Has been somebody has come along that's high conviction, they've done their work, with us having introduced the business to them a while ago, and they want to move early.
You mentioned you're looking forward to some of these businesses getting to that you bought 4 years ago, being able to sell. And the world's changing so quickly now. And like, say, for instance, your software one, we've seen software stocks, halve in a matter of weeks. Mm-hmm. How are you feeling about AI as both a pro and a con to your end sale value when everyone's looking so short term because they don't know what the future is going to be in some of these things or what AI is going to be able to take over?
Yeah, it's an interesting one. It's very situational specific, right? Like all the businesses, we keep screening them for AI risk and opportunity. We've got a head of AI in our team that's working with all the portfolio to do what they need to do for their business on AI. And so they're all, in terms of from a risk standpoint in AI, we feel like they're very high quality and protected from the risk. So there's a lot more opportunity from AI in our portfolio than risk. And SaaS isn't SaaS and technology is not technology, right? Like Permacon, Oricon, yes, it has a SaaS part of its product, but it's deeply integrated into all of the parking assets on the street, deeply integrated into all of the revenue collection and ERP of the councils around the country, who aren't necessarily the most forward thinking when it comes to technology. That business has had numerous approaches, including this year. And so it's very situationally specific. We are in market with about 5 different businesses, and it will be really interesting to just see where things land. But Again, this year it's AI and Iran. Last year it was Trump and tariffs, and a few years ago it was COVID. So there's kind of always something that means that certain investors just can't look at it right now, or certain stocks have been hammered more than others. The AI one is a very interesting one. We've got a particular view on how that might evolve. The thing I will say, though, I've been quite careful on new technology investments right now, and I think with an ever increasing awareness of where there is opportunity and risk. But what we're already seeing in the market on new things, where it's clear that something's on the right side of AI, you're seeing massive multiple expansion in those businesses. So, for example, Fat Zebra there is the leading business in digital payments in Australia. They touch about 20% of all digital payments in Australia. So it's technology business, but deeply plumbed into all of the banks, Visa, MasterCard, etc., commonly regarded as being absolutely on the right side of the AI debate. The interest in that asset is massive and has only increased since February. So, yeah, it's not one to give a perfect answer on. I think we're clearly well aware of the trend. We're watching it very, very closely, cautious on any new technology investments to make sure we're right. And if there's uncertainty, we just won't invest. But still seeing all of the technology businesses in our portfolio growing rapidly, still getting approaches to buy them, and all of them are on the right side of the sort of conventional AI debate. So the reality is, with regard to software, if we saw a business 3 or 4 years ago that was it was a nice to have feature, it could plug in quite easily and be turned off quite easily. It wasn't creating a data set that was critical for driving the business and creating more stickiness and growth with customers. It wasn't deeply embedded in a workflow or deeply integrated into lots of parts of the system, of the networking, and including hardware. The old test we would say is, like, if we gave some smart people $5 or $10 million in 6 months, could they build the software? We weren't investing in those 3 or 4 years ago, right? And so what's happened is, obviously, AI has just made it far easier to replicate and build those sort of software products that have that risk of being turned off easily and be replicated quickly. But we weren't investing in those ever anyway. But, even if you build it and replicate it, you got to go get the customers, and having customers is a pretty valuable thing. So I think it'll be interesting. It's an interesting time to be investing, and we'll all see how this sort of AI thing plays out. But our feeling is, if you're a technology business and you've got lots of customers and a customer installed base, you've got significantly more opportunity than somebody that might think they can build your product pretty quickly, but is starting from scratch on having customers. But can you sell your software for as much as you could 2 years ago? Don't know. You'll have to find other ways, I think, to try and drive value and upsell for each customer. So I think the very interesting thing for software is that a big driver of, you see these rule of 40, rule of 50 metrics used in software, a lot of that came down to price and incumbency, because net recurring revenue was driven by, and Ellen, I know you have software from had a career in software, but net recurring revenue was a key sort of metric people looked at. A lot of that was just increasing prices on your customers every year, and people like Salesforce and things were masters of that. That's getting a bit harder. So that impacts growth rate, but also impacts EBITDA margin as well. So software businesses will have to be more thoughtful about how they do that. But yeah, be happy to go through any of the portfolio and talk about why they're very low risk of increasing churn from software. They're all vertical, they're all deeply integrated, mission critical workflow tools, building up data sets that business uses in other places, and they're all vertical, so they're very sector specialized, like FTP, which we talked about. We were looking at that over the break, even with the advent of new developments in AI, but minimal AI risk in that. It's deeply plumbed into all of the trucks that are driving around on site, deeply plumbed into all the network assets on site. Critical tool for workflow. If you try to replace it, you have safety. If it goes down, you have safety issues. You have network black spots that impact production, which can be millions of dollars an hour. So that one feels like, as an example, extremely low risk. So, sorry, there's another question back there.
Hey, Chris, just on your portfolio mix, is that just an outcome of businesses you decided to invest in? And do you see that changing going forward? Or
Look, it is an outcome of businesses. It's a bit of top down, bottom up, right? Like we ultimately are micro investors, and we look for the opportunities in front of a good company, and we look across quite a lot of sectors. But we obviously do think about diversification. We do think about sector diversification as well as business model type and geography. And historically, we've looked more in certain sectors than others. So private equity. We don't invest in any property or hard assets or anything that's unprofitable biotech or anything like that. So that cuts out a big part of the market. Tend not to invest in anything that's too capex intensive because we're trying to drive strong returns in a relatively short period. So you're looking for pretty scalable business models. So that brings you back to things like business services, technology, and steers you away from things like very heavy industrials. So there is some, you do get a little bit of a sector skew as part of that. But apart from being slightly vigilant on technology and what we'd invest in there, we're not sort of expecting a giant change in the asset mix over time. And again, AI is as much of an opportunity as it is a risk, right? And one of the things we're getting our head around is what's an AI improvement thesis that we would back. We're seeing a lot of, saw a very interesting business services company the other day that's got like 100 people just doing very manual processing. We need to develop reflexes around how we would get comfortable backing an AI improvement thesis in that sort of business, but it's creating a lot of opportunity as well as risk for some businesses.
What's the range of the stake percentage? So when you start to talk to owners, what's your minimum or maximum?
So the question was, what's the range of ownership percentage? It tends to be between 30 and 80%. Only about a quarter of the investments we've made have we been a minority. Most typical is around 60%. So we rarely own 100%, and we're rarely ever going to own less than 30% because even where we're a minority, we only want to get involved where we can be just as active, engage in just the same way, bring the full resources of the firm. And even where we're a minority, we're normally the largest shareholder. So we still have that influence as the largest shareholder. So we're flexible. The thing that we look for is a great partnership opportunity because we're finding great founders who've established businesses in really interesting niches. They really know their customers. They had the vision to build a product or service that was meeting a really unsolved need in the market. They're often kind of visionaries and inspiring people who can attract great talent to their business, but they need help with setting a strategy, building a plan, hiring people around them, because often founders aren't perfectly formed CEOs. There's very few that can make that transition to being a perfect CEO of a much larger business. So we're looking for those marriages where it's a bit cheesy, but 1 + 1 can equal 3. That's where you get the best outcomes. And that's why we like partnerships where we can find those conditions.
Hey, Chris, in terms of your business, what were the main motivating factors to add the Horizon Fund from your side?
I think it was it's been a very big trend globally. So I don't want to pretend that we were the first to come up with it. We've seen, if you look around at all of the big fund families globally, Blackstone, KKR, they've done this. A big part of the reason is to just take out the middle person, because if you think of capital, how capital flows down, there's a mum or dad investor in America who then puts some money in a pension fund, who then that pension fund then wants to invest in Australian private equity but doesn't have coverage in Asia. So they then give it to a fund of funds in Asia who then comes and invests in our closed-end fund. And you can imagine the sort of fee leakage all through that. And the fact that we don't actually have any contact with our end customer. It's kind of akin to investing in when we look at a wholesale or distribution business, it's like, do you actually know the end customer, or you could lose lots of your revenue just by a decision that happens way up the chain. So there's a few things. One is we think we can offer a compelling product, taking out a lot of the fees out of the middle, but we also like to be closer to the decision makers and the people that actually ultimately have the capital, right? And so, and the third reason for us is kind of diversification of capital base. We want to have, we're thinking about building a very stable, enduring business that's going to be around for another 10, 20 years ourselves. And a good path to that is not to have too much concentration from any particular geography or particular institution, individual names or type of institution, because capital flows evolve globally, trends globally, different parts of the market. We're seeing some of the, trends now moving against super, right, where money's moving out of super. Those things happen and we want to be diversified. Yeah. But also just saw opportunity. This is a trend globally. No one was doing it for mid-market private equity in Australia and New Zealand. No one's really doing it for private equity just in Australia and New Zealand. PEP's got a gateway fund, but again, that invests globally, multiple stages of fees. Great investors know the PEP guys, but that's a different product. There's been some other semi-liquid products that are early stage tech, like Bombora and some others. That's not our business. So there wasn't anybody really offering access to mid-market private equity in the way that we do it.
So when a new investment comes along, how do you work out the split between Horizons and your existing closed investment?
Yeah, so the majority is always going to be go to the closed investment, because that's the Horizons as a co-investment product.
Yeah.
And then it's a little bit, we take a few factors into account. It's not a perfect thing to quantify because firstly, the investment sizes are different. So sometimes we need to write a $40 million equity check. Sometimes we need to write a $120 million equity check. We're mindful of that. We're mindful of driving diversification in the closed-end funds and Horizons. Horizons is scaling slowly, so we want to make sure that the new investments made in Horizons are meaningful. They're going to make a difference. So the checks that Horizons are writing now are slightly bigger than the ones it was writing when it was sub 100 million, for example. And we're also over time trying as best we can to kind of, and we'll never be able to do this perfectly, but as best we can kind of, again, replicate the sort of diversification, exposure, etc., in Horizons as closely as we can to the closed-end funds. But so it's quite a few things that we take into account. It's not perfect sort of cookie cutter. The machine says 14.5% goes to Horizons. It's a few different things. So,
is Horizon going in on a pari-passu basis with the other?
Yeah, absolutely.
Yeah, it's always
exactly this.
Okay.
Yes, absolutely. Yeah.
And on the redemption point, other than the frequency of redemption cap, is there a cap on total or the volume of redemption?
Yes, it's 5% on a quarterly basis is a cap. Yep.
Per quarter.
Just because per quarter, yeah, just because we have to manage liquidity. So.
And is that ever 5% that hasn't been triggered?
No, we've had like that's 0.1%.
Yeah, the average is less than 0.5%. That's also gross though before applications. And so you've only ever had net inflows. That's right. Yeah.
Absolutely. Yeah. There's been very few redemptions today. So we do encourage people. It's a long-term investment, right? It's like don't use it as something you trade in and out of, but the liquidity is there if you need it.
How do the valuations and mechanics work? Like, let's say around this table, we went, there's $5 million. How's the actual process work? Who values them and how does it get in? And
so there's a monthly NAV, but the NAVs are set by an external valuation or a valuation committee chaired by an external person. So the way that on a monthly basis, we do the valuations internally. And what we tend to do is a major review quarterly and then by intra-month on a monthly basis by exception. So on a quarterly basis, the team that works on each investment is pulling together the financial performance. They're updating the earnings and the cash position in the company, seeing if anything has really changed in the multiple that we look at, though the multiples being listed comps and obviously being mindful they're often much bigger than the companies that we're investing in. Have there been any recent transactions that look very relevant and good indicator of value? Then that feeds up to a valuation committee, which is chaired by an external person. And that person used to run EY's valuation business throughout Asia Pac. So, and they're independent of 5V. So, and then the NAV, the buy-in NAV is set on a monthly basis. But again, we do sort of quarterly deep dive on valuations and refresh monthly by exception, as something particularly happened generally to that business, good or bad. Did it make a material acquisition, which we think transforms the business? Did it, on the unfortunate side, did it lose a customer we think is material and we would therefore not wait for the next quarter to change the value.
I mean, it's probably worth quickly saying, you know, I'm with Pinnacle, we're the distribution partner for the Horizons Fund. There's probably 3 reasons why we find clients like Horizons over, say, the closed-end funds that 5V offers, other than the access, which is more difficult in the closed-end funds. But the first one would be just the hassle of drawdown structures is difficult for many individuals to deal with, and investment platforms and so on. So that would be the first one, is not having this capital call drawdown. You just put your money into Horizons and you're immediately getting access to a portfolio of 21 investments. The second one is because it straddles vintages of the closed-end funds at 5V, you're taking away what Brendan was saying earlier, which is needing to time whether it's a good or a bad year in the market or couple of years in the market to invest or redeem your closed-end fund, because you're essentially rolling from one vintage or a couple of vintages at any one time. As new things come in, other things roll off, but you're always going to have a portfolio of 20 to 25 investments. So that's the second thing that's really important. And the third one, because of that, is when it distributes, when the fund pays a redemption, this is more of an accumulating vehicle. So it doesn't actually pay out the capital from a distribution. It keeps it in the vehicle, in the unit price of the vehicle. And so you're sort of essentially got like a DRP almost going on in Horizons. So when the portfolio gets realized, your capital remains in the fund. And if you want to sell, you just redeem your units in the fund. That's available to you. But if you don't and you want to stay in the fund, well, your capital just stays in there and it just grows over time. Whereas in the closed-end funds, as you probably know, when the fund sells an investment, it makes a distribution, you get this capital back, and now you have to figure out what to do with it. So those would be probably the 3 things that we're finding most appealing for our client base, which is investors like yourselves in Horizons.
Does that mean you don't pay any capital gains? Like, how does that work? Obviously, sometimes these things have various, trust, tax efficiency.
It is a look-through vehicle, just like the closed-end funds. So when we sell something, there is a taxable gain, and we distribute a portion of that. Yeah. We distribute a portion of the proceeds to cover the cash impact of the taxable gain, but the rest can be left in Horizons, as Chris says. Yeah.
And so you probably covered this. What is the minimum investment?
There's just the platform minimums.
Oh, I get you.
So it's available on 8 platforms, all the major ones.
Okay.
Zenith and
Premium, I think. Yeah.
Zenith and Lonsec recommended. So it's
$5,000. So
yeah. So very low. Yeah.
Right. I know you got a 1:30. Appreciate your time. That was really good.
Thank you.
Thank you for coming in and having a chat and giving us a look through and understanding of fund and some of the success. Look forward to next 12 months.
Yeah, thank you. And thanks again to Shores. We've enjoyed the engagement over the last few years and appreciate you doing events like this and for the support to date. So hopefully it finds a good, unique part of the portfolio. And looking forward to continuing. So thanks, Brendan.
Awesome. Thanks, Chris.
Thanks. Thank you all.
Thank you.